Hello traders, Gary Wagner here. Approximately 11:30 in Honolulu, 5:30 in New York. It is Friday, finally, the 11th day of May 2012, and this is the daily report for gold and silver, our weekend review. And what a week it was. Sharply lower prices across the board in the precious metals markets on the week as a whole. We did end, I would say, modestly to substantially lower today in gold, down $13. Testing first level of support. We'll be talking about support levels and where we think this market's going through the show. 1581.40 is Kitco's close when we look at June gold, 1584. The low was 71, 1571, high 1591.90. Silver down about 0.5% off 15 cents, 28.99, with a low of 36 and a high of 29.23. Obviously, bearish sentiment through the week and bearish sentiment today in the precious metals markets. Today, a reaction to a trader over at JP Morgan losing approximately, as they call it, about $2 billion, putting on what is known in the industry as a dynamic hedge. And he did that all in about 2 weeks. The markets reacted and reacted with skitters, meaning it was a risk-off day in the marketplace. That's quite a trade, gentlemen, with the nickname of the London Whale. Now, other influences in the market today were both the dollar and crude oil, with the dollar trading higher, crude oil trading lower. First chart that I want to look at on the day is going to be our dollar index chart. It is a daily chart. It is in Henkin format. And the reason for bringing this up and shrinking it down, does the dollar have potential to continue to go higher? Because the dollar, of course, is a huge indicator in terms of where gold is going to go. And as you'll hear from our prognosis today, as we have been talking about all week, my belief is that once we strategically broke through that support area on the compression triangle, we were headed lower. How much lower? First to 1580. That's what we talked about at the beginning of the week. And the next target is going to be 1520, which is the recent low. Reason for saying that while we're looking at the dollar index is, does the dollar index have further to go? Well, it doesn't have any real technical resistance really till about 82, strong resistance. And as you can see, some of these record tops up here, 92 and 94. This, of course, is against a basket of 6 currencies. But the euro dollar is going to remain, in my opinion, under tremendous pressure as the elections that we had in Europe last week signaled potential change in the way they look at, they view, and they are going to react to the current austerity measures in Europe. Does the dollar have further to go? In other words, is there room for upside? Well, the short answer has got to be yes. You know, we've been talking about the fact all week that we have a marketplace right now that on a strategic base could, in fact, head a lot lower than it currently is. We are looking at a weekly chart. This is June COMEX Gold. We're going to look at it in this format and then look at it in Henkin Ashi. Reason for starting out by looking at it in straight candlestick format. Really, the big difference between candlesticks and Henkin Ashi is that the Henkin Ashi chart fixes the open as a midpoint of the prior day, where open, low, high, and close are the 4 points of a current session on a daily chart, current week on a weekly chart. So, on a red candle, the absolute high of the week, as you can see up here, matches to 1639. That's the top of this red candle. As this market moves lower, it closes near, not at the lows, but very, very close to the lows. As you can see, closing at 1584, I believe 78 is our low. Now, what does that signal to us? Well, we have 2 areas that we were looking for the market to test this week. The first of which is 1580. We have seen that area get tested, and as you can see, we have closed right at that point. Now, that's the body of these candles, as you can see right in here. The next real level is going to be 1520, which is the intraday low of the market when it dipped down back in October of 2011. And then the third area, and this is the worst case scenario, or I should say lowest case scenario, but that would be if gold actually goes and retraces to a 38% retracement level. Now, why are these two levels so critical? Because one of the things that we talked about really throughout the week was the possibility in the way that this market is reacting, that what we are actually witnessing right now is a correction from the beginning of 2008, meaning a substantial correction. And the reason I believe that to be a significant possibility, it's not written in stone yet, but more and more indicators point to that. And the reason that I feel that way is when you take a look at this marketplace itself, and we take a look at this critical support line. This support line was absolutely, without any kind of a doubt, breached, traded below, and traded through on today's trading activity. Now, what does that mean? That means that there is a potential that this correction, which began when the market was trading roughly at 1920 and was trading from a starting point of roughly 720, tremendous move. When we take a look at this kind of a move and then we consider the kind of correction that is possible, the first level we look at obviously is going to be our 23% retracement level. Now, what is interesting is when we draw this compression triangle, of course, our original belief was that it would go through 5 legs and have this upthrust. That was incorrect. We were correct in that we had a compression triangle. We were incorrect in predicting the direction of the breakout. There can be no doubt about it. Our stops protected us, took us out with a $25 loss. And for those aggressive traders who's been getting short over this last week because of the different benchmarks we have been talking about, 1580, 1520, there's been some profit there. Officially, we have been flat in the market, but I have been speaking with a number of my daily subscribers who have been initiating short positions in this market. We'll move on to our daily gold chart in a second. But the first thing that I did want to do is convert this candlestick chart into what is called our Henkinashi. And of course, our Henkinashi is going to be taking the midpoint from the prior session, in this case the midpoint last week, and making that the open on this week. Now, when we look at it in this format, the biggest change you see, of course, is when we look at the open of this week's candle. You see, once it was fixed on the open, the straight open, meaning Monday's open, you saw that it was at 39. When you fix it to the midpoint, you can see that it comes above it, and it doesn't really close quite at it because of the way they actually plot the close, same way that they plot the open. Very, very similar formula. But in both cases, we can absolutely see that, at least on an interim basis for now, we have broken below this long-term support line. My daily subscribers know that I have been looking at 2 plausible scenarios in which we could see this gold market play out. The first of those scenarios is just what we are looking at, and that is that we have had this significant breakdown. We have broken out of this compression triangle. This market is headed lower. Where is it headed? Well, there's 2 new spots we want to plot. We talked about this through the week. Let me try to line it up. Regardless where I line it up, comes out to about 1520. And then most significant support is well above where the market is, but that's at 1463. You can see that on our weekly chart. When we move to our daily chart, this again is of June gold. You can see when we look at that same long trend line, it is absolutely broken out. Why have I drawn the trend line in this way? Because as you can see, drawing it in this way, we have definitely got these lows below that critical support area. Now, the reason for doing that is to show that there are times, I fixed it off of these major lows here, so that we could say with some certainty that this is a fair and accurate depiction of this support line. And the reason for drawing it there rather than fixing it from this low and this low, as many times is done, is because, as you can see, we have a marketplace that deviated, broke below, and then right after it broke below, it had a significant move back to the upside. You see it breaks below here, and then we get a really strong, huge rally to the top of that compression triangle. Now, why do I bring that up? As a secondary option in the market, in terms of the scenarios that we could see play out, the other scenario that's possible is that this market actually recoups, just as in this area, that it goes ahead and recoups, it moves back up into these channel lines, and we either get one thrust up, break above, or we complete this with a fifth and then a thrust up. Now, what seems more likely to me at this point? Well, right now, the bears have the field advantage. There can be no doubt about it. This is a significant break below it, and when we do a much shorter term support area, and when I say shorter term, I'm not going back at this data back in 2008, although these line up, but I'm simply matching this low and this low, creating the angle, third low matches up here, and then we get this real significant break. Again, this is a daily chart. This is in Henkin-Ashi format, so it is going to look a little bit different, but you can see we have had all through the week, based on our Henkin-Ashi candles, solid red all the way down. This is that same daily chart. All we have done is converted it from a Henkin-Ashi into a standard candlestick format. And the reason for doing that is what you can see is that we have had a significant breakdown below this support line. You can also see very, very clearly, and I'm going to try to line this as straight as I can, you can see that we do have some more downside potential based on simply matching this low here, which, as I said, basis the cash month, is approximately 15.20 per ounce. Lastly, I want to take a look at the silver market, first from a longer term perspective, and then we'll blow this up to look at it from a shorter term. Henkin-Ashi daily chart, July silver. We are plotting two basic Fibonacci retracement levels. We are looking for harmonics in the market. First level starts at the beginning of this rally. This is back October 2008. We see a $9 per ounce move up to almost $50, actually plus 50 on this July contract. Second retracement level is going to come after we had a consolidation or sideways trading pattern here, and we get, it's really the beginning of this big spike at about 18. So it had already doubled, went to 18, and you can see we've got these two retracement levels. Now, why is that important? Because what I'm looking at is harmonics. In other words, different areas in which we could see this marketplace go to based on the fact that those numbers have significant meaning on more than one particular fib study. And when we take a look at it in that way, we have a fairly critical area. When we look at this bottom right in here, and what you can see is that a 76% retracement level, 2566, these lines here are of the shorter retracement. This of the longer retracement goes back to here, as you can see the ends here. So it's the easiest way to look at it. So here, a 61% retracement, roughly $25, $24.90, and then $25.66. This, to me, is a very, very critical area that, should silver continue to meander down, in other words, sell off, which I currently believe it will, I think it has a very realistic opportunity to see this market go to about $26, just below it, before finding support in the market. And as I said, that's based upon the Fibonacci retracement sequence that we have outlined. Now, I've gone ahead and blown this up just a little bit so you can see the kind of activity that we've been witnessing on a daily chart. And although it is not straight red, we've got a couple of days in there where it goes green for just a moment. The basis of this market has been a slow progression down. It broke through what I consider to be critical support, which was roughly 30.52. This shows it at 30.45. But when we consider what we're looking at, it's really based upon the bodies of these candles. This support area here, and you can see it roughly matches up to this area here. Once we broke through there, my sentiment is we really don't have any substantial support until we start to get into this zone here, just above $26 per ounce. Where do I think silver's headed? I do think it's headed lower. Where do I think it's headed price-wise? Well, I think it has the potential to go to $26 per ounce. This has been Gary Wagner, wishing you as always good trading. We'll talk to you on Monday for another daily update and review. Bye-bye.